Hello students, welcome to today's lecture on taxation. In this session, we will cover the basics of what is tax, explore direct and indirect tax types, and touch upon key aspects of income tax, including slabs and deduction. Taxation is basically how government collect funds for public services. There are two main tax categories. One is direct tax, another is indirect tax. We will look at examples of each. We will also discuss income tax, where we will explain tax slabs, different tax rates for different income levels. Plus, we will talk about deductions, which can lower your taxable income. By the end, we will grasp the essential of taxation, setting strong foundation for understanding these crucial financial concepts. Let's get started. Before we dwell into topic of taxes, let's take some moment to explore some quotes from thinkers and philosophers around the world regarding taxation. Benjamin Franklin once remarked that in an uncertain world, two things are inevitable. The first is death and another is taxes. Another philosopher, Jean-Baptiste Colbert, linked tax collection to plucking feathers from goods, aiming to gather most feathers without least hissing. This quote is from the famous Prime Minister of Great Britain, Winston Churchill. He famously stated that there is no such thing as good tax. In essence, these quotes highlight the common sentiment that taxes are universally regarded as a necessary but often unwelcome aspect of our lives. So what is tax? Tax is essentially when government collects money from people or businesses to cover public services. They do this by imposing taxes on individuals or corporate entities. Tax is essentially the foundation of whole taxation system. It might be or it might not be the most exciting topic, but understanding how it all works is pretty important, because as your earning grows, your income tax will also grow. So this lecture will tell you how you can manage your taxes effectively, means how you can keep your tax levels at minimum. So tax is essentially financial charge imposed by either by state government or central government, or by both, on individual or companies. The money collected through taxes serve various purposes, such as building the nation's infrastructure, supporting development projects, allocating resources for defense, including arms and ammunition to safeguard country, and also funding other welfare related initiatives. It's a way for government to generate revenue to meet these important needs. So all money of the government come from taxes. The primary purpose of taxation is to generate revenue for the government. This revenue is then used to fund wide range of activities and programs that benefit the nation as a whole. These activities include important things like building and maintaining infrastructure, supporting a welfare program, and ensuring national defense. Now, beyond this primary purpose, the taxation serves several other purposes and important goal. One of these is to redistribution of wealth. Okay, taxes can be structured in a way that it takes more money from those who have more and less from those who have less. This helps to reduce income inequality and create a fairer society. Taxation also plays a role in maintaining price stability. By adjusting taxes on certain goods and services, the government can influence their prices and prevent drastic fluctuations that can disrupt the economy. The next is controlling inflation. Government can use taxes to manage amount of money circulating in economy, which in turn helps to keep inflation down. So when money in circulation increases, prices increases because demand increases. Lastly, taxation can encourage investment by offering tax incentive or reduction for certain type of investment. The government can motivate individuals and businesses to invest in areas that contribute to economic growth. So if government wants infrastructure field to grow, then government will give concession on taxes for the money invested in infrastructure bonds. So about the tax structure in India, taxation system is primarily divided into central government and state government. The division is based on two type of taxes, direct taxes and indirect taxes. Means central government can impose direct as well as indirect taxes, and state government can impose direct as well as indirect taxes. Direct taxes are imposed on your earnings or income. This includes taxes like income tax, where the amount you owe is determined by the income you earn. The responsibility of paying and depositing direct taxes lies with the individual or entity earning the income. This is because these taxes are directly connected to your financial gains. On the other hand, we have indirect taxes. These are the taxes levied on expenses or transaction. When you purchase goods or services, you often pay indirect taxes. An example of goods and services tax, that is called a GST, which is common type of indirect tax. Unlike direct taxes, the responsibility to deposit indirect taxes typically falls on the businesses and corporation that provides the goods or services. They collect these taxes from consumers during transactions and then deposit them with the government. Let's take a look at the slide which presents the tax structure in a diagrammatic form. As you can see, taxes are divided into two main categories, direct and indirect taxes. Direct taxes encompass different type of such as income tax, wealth tax, capital gain tax. These are taxes that are directly levied on individuals' income, wealth, or profits. On the other hand, in the realm of indirect taxes, we have goods and service tax, that is GST, stamp duty, customs duty. These are the taxes imposed on goods, services, and transactions. Now, furthermore, there are a variety of other taxes that contribute government revenue. These include profession tax, excise duty, toll tax, road tax, and more. These taxes are collected by either the state government or state government. Remember, from cradle to coffin, everything comes under tax. The most important tax that you will deal with is income tax. The government collects money from different kind of people and groups like regular individual families, that is called as Hindu undivided family, businessmen, and some other groups called as body of individuals and associations of person. The government does this because they need money to do important things in our country like building better roads, schools, and hospital. The money helps the country grow and become better. Now, how much money you have to pay depends on how much you earn in a year. The government takes part of your income as tax, and that is called as income tax. The part of your income is taken by the government, okay, known as income tax. They divide different income levels into groups called as income tax slab, and each group has a different percentage of tax you have to pay. So if your income falls under the category from 5 lakhs to 2 lakh, you have a certain percentage of tax you have to pay to the government. If your income is less than 2 lakhs 50,000 per year, you don't have to pay anything to the government. This way of collecting money is important for the government. It's like their main way of getting the money they need to do all the things that keep our country running smoothly. So it is income tax slab. An income tax slab is a variety of categories that the government makes to group the income of individuals. The amount of tax that a person must pay depends on how much money they made in the financial year under consideration. Financial year is from April to March in India. There are now two different type of tax slab. The one is called as old regime and another is called as new regime. So you can pay income tax according to either old regime or new regime. Each regime has distinct rules for calculating the appropriate tax based on individual income. It's crucial to note that the income tax slab differ between old and new regime, playing a key role in determining tax obligations. So you have to pay income tax, okay, based on your income, but it depends on whether you are paying a tax according to new regime or old regime. So let's say your income is 12 lakhs. So if you are paying tax according to old regime, it will be different. And if you are paying a tax according to new regime, it will be different. We will see this in detail. In this slide, you will find comparison of the tax slab between the old regime and new regime. Alongside each tax slab, there is a demonstration of how tax is calculated based on your income. Calculating income tax can be intricate, involving an understanding of income tax exemptions. However, the availability of clear online calculators and tools help in today's world. By inputting your income and investment details, these deductions streamline or these calculators streamline the process. So though calculating income tax is a bit tedious, you don't have to worry. Online calculators are available. So income tax calculators are also available on the government website. You can check it out. It is the income tax website. So don't worry about this slide. You don't have to remember. It's readily available everywhere. Now, two key difference you should know here. The one is between the key difference between assessment year and financial year. The financial year is a period in which you earn your income, and assessment year, on the other hand, is the year that follows and in which you file your income tax for previous year, income tax return to be precise. Let's take an example. Imagine you started working at a company on 1st of August 24. Your first tax year would be financial year from April 24 to March 25. During this period, you would be taxed based on the income you earn from August 24, because you started earning from August 24 to March 31st, 25. So the financial year for or the tax year for you will be 2024-25. Consequently, the assessment year means your tax will be assessed, will be examined by the income tax department in the year 25 and 26. As this is when the tax is paid and assessed for previous year. So the tax paying year is the taxation year, okay, or the financial year, and assessment year is the year next to it. Now, besides salary, you have to pay income tax on a lot of incomes. Income tax is to be paid not only on salary you earn, but also on the other income you earn in the financial year. Interest earned on saving account and other bank deposits, income from house rent earned, income from profits in mutual fund or stock market or sale of shares, income from business, all your income is taxable. You have to pay income tax on all these things. Income tax deductions and exemptions are advantages designed to decrease your taxable income, thereby reducing your income tax burden. Deduction specifically refers to amount authorized by the income tax department to decrease your overall income, leading to reduction in your tax obligation. The sum of all your earnings is termed as gross income. By subtracting deduction from this gross income, you arrive at your taxable income. Okay, and you have to pay income tax on this taxable income. So you don't have to pay income tax on the gross income. You have to deduct the permitted deductions amount from your gross income, and income tax is levied on that. The deductions are granted under section 80 of the Income Tax Act. Section 80 holds a significant place in the Income Tax Act, offering multitude of deductions during income tax calculation. This slide illustrates the diverse investment options falling under Section 80C of Income Tax Act. When you invest in these instruments to cover life insurance premium and tuition fees for your children, the invested amount is subtracted from your income and taxation is applied to the remaining sum. However, there is a limit on investment amount, which is presently 1,50,000. For instance, consider your income is 7 lakh and if you invest 1.5 lakhs in equity linked saving scheme or pay house rent loan principal of 1.5 lakhs, this total is subtracted from your income, resulting the taxable income of 7 lakhs minus 1.5 lakhs, that is 5.5 lakhs. So you have to pay income tax on 5.5 lakhs and not on the 7 lakhs. So this ultimately leads to a reduced tax obligation. Now it's worth noting that these deductions are not allowed in the new tax regime. But the tax rates in the new tax regime are less. So thus, if your annual income is below 15 lakhs and you prefer long-term investment, adhering to the old tax regime might be advantageous. I would suggest to evaluate your tax liability under both regimes to arrive an informed decision, because you have to tell income tax department which tax regime you are using to file your income tax return, means according to which tax regime you are calculating your taxes. So you first calculate and then inform it to the income tax department. Now here are some other deductions under section 80. Now tax exemptions are like special cases where certain types of money are not counted as a part of your taxable income. They help lower amount on which you have to pay taxes. There are few examples of these exemptions. The first is proportional tax paid. If you paid a proportional tax, that amount is excluded from your taxable income. House rent allowance, if you are paying house rent, then that is deducted from your taxable income. There is something called as standard deduction. Okay, this is a fixed amount you can subtract from your income to lower your taxable gross income to have a lower taxable amount. And there are many more like food coupons, mobile allowances. Remember, these exemptions can help reduce the amount you pay taxes on, giving you some relief. As per the Income Tax Act, there are specific payments like salary and interest that have taxes taken out directly before you receive them. This process is known as tax deducted at source. When you work for a company, your employer will figure out how much money you are expected to earn in that entire year. And if the amount is more than the basic taxable limit, you will be taxed. Okay. And they will deduct the tax from your salary only. So you don't have to go to the income tax department. They will deduct the portion of the yearly tax from your salary. If you have fixed deposit in a bank account and you earn interest on it, which is more than 5,000 rupees, the bank also will take out some extra tax before handing over you the interest amount. So the TDS that is deducted is later adjusted when you calculate your final income tax. It's a sort of like a prepayment towards the total tax you owe at the end of year. So TDS is basically the tax deducted at source. If your income is exceeded beyond a certain limit, the person who is giving you the money will deduct the tax first and then will give you the money. Ultimately, this tax is adjusted with your final tax amount. So if your final tax is 1 lakh and if you are paid 20,000 as TDS, Okay, so you have to pay only 80,000 at the end. So this slide displays different methods for reducing your income tax alongside the option covered in the earlier slide, which includes provisions under Income Tax Act 80C. There are additional ways to save taxes. For instance, you can consider investing in national pensions system or purchasing health insurance. Payments made to those go beyond 1,50,000 limit. So the payment made towards health insurance and national pension system is not included in 1.5 lakh limit. You can, it is calculated over and above 1,50,000. Therefore, acquiring health insurance doesn't just offer protection against unexpected circumstances, but also provides means to save on taxes. By the end of every financial year, your employer will provide you with form number 16, which is the most important document regarding income tax for salaried employee. Let's understand what you mean by form number 16 and one more form called as form number 26. Tax deducted at source is a process where a certain portion of your salary is withheld and submitted to the income tax department on monthly basis. This ensures that your income tax is paid in a timely manner. Form number 16 is a document provided by your employer that outlines the detail of your salary and the corresponding TDS deduction. This is issued annually, summarizing the financial year's earnings and deduction. Additionally, form number 26S is a comprehensive statement created by income tax department. So form number 16 is created by the employer and form number 26S is a comprehensive statement created by income tax department. It showcases the tax collected through the TDS against your PAN number from various sources. So it covers the TDS deducted by the bank, by any other lender, not lender, or any other supplier which gives you the money. This statement includes TDS deduction from all income streams and any tax payment made by you directly. So if you are offering some consultancy to somebody, he will deduct the TDS that will be shown to, or that will shown in form number 26 AS. Form number 16 will show only the remuneration you are getting through your employer. Now, income tax return serves as a crucial document for reporting your income and tax detail to the income tax department. The assessment of taxpayer tax obligation depends on their earnings. If your income tax return indicates an excess payment of taxes in a given year, means if your tax liability comes out to be 2 lakhs and if you have paid 2,20,000, the individual becomes eligible for income tax refund from income tax department. So you will pay TDS to the income tax department. At the end of the financial year, you have to check how much taxes you have paid through TDS and how much is your tax liability. If your tax liability is more than TDS paid, you have to pay the tax to the income tax department. If you have paid more taxes to the income tax department than your tax liability, you can claim for refund, and this refund process is done through filing income tax return. So you have to file income tax return. It's an online process. If you fail to file income tax return in the stipulated time, that is before 31st of July every year, you are liable for legal action against you. So remember to file income tax return every year. Filing income tax return is nothing but giving records to the income tax department of your income and taxes paid and paying excess tax or asking for refund. This whole process is known as filing income tax return. Filing out income tax return is really easy. especially for people who earn salary. Any person who earns money can do it themselves. Okay, there is an option called as e-filing, which is income tax department provides it, like filing out a Google, or it's like filling out a Google form. Okay, it's super simple. Okay, the choice has been made, everything, or this e-filing choice has made everything much simpler. All you need to do is to put in some of your information and where you have invested your money in the right spots, and you are finished. Means all your tax will be calculated automatically. A lot of information about how much you have earned is already filled in because it's linked to your PAN number. It's like a form that is partly filled out for you. So when you go for filing income tax return, you have to register and get income tax site. There, most of the things are free filled, because when the tax is deducted at source, the person who is deducting the tax has to inform to the income tax department that this much tax has been deducted from the income, and it will be credited against your PAN number, and it will be shown during e-filing. So remember, you have to file income tax return. It's very simple. Okay, if your income is only salary income, it's super simple. You can do it. Don't pay to CA for it. Of course, if you have a business income, then its process is not so simple. So you have to consult chartered accountant for that. Now, next tax is called a GST. GST stands for Goods and Services Tax. It's like a tax that's put on things we buy and services we use. This tax is based on how much we consume or use. Back on 1st of July 2017, India started using GST. It was brought in to replace many other taxes we used to have, like tax, value added tax, sales tax, etc., etc. So now there is only one tax across country called as GST. Now this slide shows the GST structure. Okay, GST is a way of collecting tax on the things we buy and services we use. Okay, it is designed to make taxation simpler and more organized. There are three important parts of GST. The first is SGST. When you buy something or use services within your own state, the state government puts a tax on it called as State Goods and Services Tax. This tax helps the state government collect money to provide various services and functions within the state. Another is called as CGST. Similarly, the central government applies Central Goods and Services Tax on things you buy or services you use within the same country. This part of tax or state, this part of tax goes to the central government and helps fund national level initiatives. So basically, if you are charged with 18% of income GST, then 9% goes to the state and 9% goes to the central. Now, when you are dealing with transaction that cross state borders, like if you are making transaction which is between Maharashtra and Karnataka, like buying something from another state, an integrated goods and services tax is charged. Okay, this tax is collected by the central government, and this tax is distributed among two states. Beside income tax, there is one more tax under direct tax you need to consider often when you make profits, that is called as capital gain tax. When you make money from selling something valuable, like capital asset, when you sell home or some antique clock or some antique piece, it's called as income from capital gains. This income get taxed in the year when you sell the asset. This tax is called as capital gain tax. There are two kinds of capital gain tax: short-term capital gain tax and long-term capital gain tax. The tax is calculated based on the profits you make when you sell things like shares, mutual fund, and property. Basically, antique seller also comes under this. Let's understand the difference between short-term and long-term capital gain. If you hold the asset for short-term period before selling it, usually less than 1 or 2 years, depending upon the type of asset, any profit you make from the sale is considered as short-term capital gain. These gains are taxed at different rate than long-term gains. And long-term capital gain, if you hold the asset for longer period before selling it, any profit from the sale falls under the long-term capital gain. The tax rate for long-term capital gain is typically lower than for short-term gain. Now the tax story for salaried employee is a bit short than businessman, but it doesn't really end here. There is one more type of tax that every salaried employee has to pay. That is called as professional tax. It's often collected by the state government. Professional tax is a kind of tax that is applied to various types of jobs, business, and employments. So it's a tax collected by government based on the work people do to earn living. So it is a tax on your profession. So salaried employee has to pay it, businessman has to pay it, doctor has to pay it, everybody has to pay it. The state government of each state decide how much profession tax to charge, and this can vary from one state to another. This means that amount you pay in professional tax might be different if you are working in different states. Speaking to the amount, there is a limit to how much professional tax can be charged. The highest amount of professional tax that can be levied is rupees 2,500. This means that no matter how much you earn, the professional tax you pay can't exceed this maximum value. The table on the slide shows the professional tax applicable in Maharashtra. In southern state, it's a little lower than 2,500. So your professional tax depends on the city, the state in which you are employed. So this is all about taxes and taxation that you need when you start your career journey. Be careful about taxes while calculating profits, and let not the taxes to eat major portion of your income. All the best. See you in the next lecture. Thank you.